Okay, everybody, welcome to another edition of Think with a Drink, the weekly webinar series brought to you by the Aries Foundation for Financial Education. And tonight we have a fun one. This is sort of an annual thing for us. We do this sell in May and go away, which is more of a hard look at sort of the markets, what's going on, where things are going. If you happen to tune in or see last week's episode, you know that look at the markets was a little bit more blender fueled with what we were doing with Cinco de Mayo and the margaritas and money and all that stuff. So Sell in May is a little bit more focused on it, though, of course, with everything that's going on, it might be handy to have the blender nearby, right, Craig?
Always handy to have a blender nearby, yes.
All right, so real quick on the checklist, just know we record this. You don't have to worry about your image. Your microphone should stay muted, but you don't have to worry about your camera being on or off because the only thing that's being recorded is what's being shown on the screen. There is a chat box, so if you do have questions, feel free to drop those into the chat box. My co-pilot, who I'll introduce in a second, is here to make sure that those questions get answered and to keep us on pace tonight. Speaking of your pilots, my name is Tom Alessi. I am the president of the Aries Foundation for Financial Education. I've been in financial services for 23 years now. I'm an investment advisor. That means I act as a fiduciary whenever giving guidance or advice to any of my clients. I want to bring my vice president, Craig. Why don't you introduce yourself?
Sure. So I'm Craig Richardson. I'm the vice president of the Aries Foundation. I've been in financial services for over 18 years now, and I specialize in working with families, help them define their financial goals and have a better relationship with their money.
And as I said, Craig will be chiming in as we go along, but he's also here to man that chat box should any questions come up. Told you that tonight's episode was sponsored. It's brought to you by the Aries Foundation for Financial Education. You can visit the site. It's www.ariesfoundation.org. And the mission behind Aries as a nonprofit is trying to help everyone have a better relationship with their money. Because whether you realize it or not, you are in a relationship with your money. And just like every other personal relationship that you have, there are triggers and emotional behaviors that cause us to act somewhat irrationally sometimes when we're dealing with our money and our finances. All Craig, myself, the rest of the Aries team that we try to do is help everybody take a little handle on that, take a little bit of the emotion out in dealing with your money. Disclosures, I'm not going to read this, right? Because we're a nonprofit. This is all educational. All of the opinions shared by your are those of your presenters, basically, right? So just know we're doing this as an educational thing. That if you ever do need any advice, though, we always recommend that you seek out the help of if it's tax, legal, or financial, to seek out the help of a professional if you ever have any questions. And that was just a little bit much for me right there. So I finally come to the fun part of the evening. We call this Think with a Drink because we want to have this be a little bit more casual, a little relaxed. And we can't think of a better way to do that than as if you have something cold to sip on as we're going along and presenting all of this. Last week it was margaritas because it was Cinco de Mayo, but now we go back to our standby. And because Sell in May tends to be a more of an ongoing thing for us, this is Jack's Abbey, their house lager. And the way they say it is, what the hell's is a land beer, basically. So this is, as they describe it, a sweet and golden, full of malty, pale beer based on the lagers of Bavaria. It is their house specialty, and because this is one of our sort of house band type things that we do, it's our house lager as well. So, and I know, Craig, you've got the same.
I do.
I'm going to pour this again.
And for those who can't see Tom, he's wearing a Bruins jersey in honor of which game is this? 6?
Game 6. This is win it, go home, baby. That's why I'm a little quick here because the Bruins dropped the puck, I think right now or soon anyway. So I want to make sure I get to it. Just a shout out to the folks at Jack's Abbey who gave us the beer for this evening. You can visit them. They're at 100 Clinton Street in Framingham. It's great beers. terrific food. The fun of going to the brewery a lot is that there's stuff on tap sometimes that is not available to the rest of the people. You can only get it there at the brewery. And one last shout out for Mayfest, that is the weekend, May 20th through the 22nd. Lederhosen encouraged for all, Craig. So I'm going to say Skol.
Oh. And if you're a brewery that wants to give us free beer, you can reach us at www.ariesfoundation.org.
All right, so the agenda for tonight. So the story behind sell in May and go away. What does it really mean? The emotional roller coaster that's involved with that. 3 key indicators to watch as we go forward, certainly in the next couple of months for what's going to happen. It's a wash your hands and it's actually touch your portfolio. And then an idea of some of the strategies you can do, some of the things you can be looking out for, or what can you do with what's ahead. So we did call this sell in May and go away, but Craig and I had originally thought about calling it fear and self-loathing in the stock market wasteland, but we thought that was a little too negative there. Take off on fear and loathing in Las Vegas. So
that was very depressing with Think with a Drink on the label there.
Yes, it's Think with a Drink, but it was fear and self-loathing because that's what everybody's feeling right now, right? There's a lot of pressure out there and there's a lot of talk about what's going on and what's happening. So let's start with sell in May, right? So it actually doesn't originate with the U.S. markets. It originates back in old London, like in the 1800s or so, when it was just about when stuff was being sold and come through. It got adopted in the U.S. marketplace sometime in around the 1960s or so, because they realized that some of that actually, what was that with my cousin Vinny, right? Does it hold water, right? Is that what that is? Does the defense hold water, right? Right, that whole thing, right? Well, so the idea here is with sell in May and go away, that the 6 best months of the market are from November to the end of April. And they've sliced this back and forth all the way back to 1900 or so, and looked at the iterations to say the best 6 months of the year are November to April, which makes the worst 6 months of the year May to the end of October. That's where sell in May and go away sort of comes from. But one of the things with that is the 2 worst months, and I don't care how you look at them, month by month, year by year, a slice of 5, a slice of 10, whatever it is, the 2 worst performing months of the year are September and October. Now, there's a lot of different theories and reasons for that. September, like everybody's gone, right? Nobody's around in August. So it's, hey, I came back after Labor Day and now I got to take care of stuff because I wasn't looking at anything for a month. And then in October, all those financials, the investment companies, mutual funds, those type of things, that's their fiscal year end. So they have a tendency to do a lot of tax harvesting, selling, and truing up a lot of portfolios in the month of October. So you have some causal and effect there in terms of why that happens, but that's really what the stat is. We'll talk a little bit as we go forward about whether or not it makes sense. This year, I can't, you would have had to have already done it. Right now, you're already strapped in. The ride is already going over the edge. So, right, Craig, you're not doing the sell today type of thing.
Well, I'm going to go get my helmet. I'll be right back.
Yeah, it better be a good helmet because it's going to be a long ride, I think, in terms of dealing with that. Okay, so the terms that are getting tossed around, and just so we're clear, we bring this up every time. A market correction, whenever some talking head or squawking head says, "Hey, the market's going to correct," or "It's in a correction," or "Headed to a correction," they just mean it's down off 10% from the 52-week high. Now, the 52-week high for this particular market in the S&P 500 was on January 3rd of 2022. So we're in the same year of that 52-week high, but the idea is you have that drop of 10%, and we'll talk about that because we'll look at the S&P 500 and see where that's at. When they talk about a bear market, that means being down 20% from the top. Now, we're not there yet. We're very, very close, though. We're going to talk about that in terms of where that's at. And a recession, because that's the word that's coming up now. We're starting to hear that R word start to rear its head, and that the 2 consecutive quarters that the GDP, the gross domestic product, is in a negative. That's a recession. And inflation, this is going to be all over the place, because this is a marker and something we're going to be talking about and looking at as we go forward here. And they literally just released the number yesterday for April, so it ties in specifically to everything that's going on. But this is getting us a lot of that, Craig, like we like to talk about, that roller coaster of emotion that happens with the markets.
Yeah, and I think it's maybe a little exaggerated the last 6 months because of the amount of volatility everybody's been feeling. So I would say, where would you think we are in that roller coaster ride right now?
Well, so where we were prior to all of this craziness happening, like the end of last year into the beginning of this year, where we were was there, right? We were in euphoria, right? It was still, rainbows and unicorns, and everything was going well and everything's going up. Where we are today, you're probably here. We're getting past fear right now. Right? Fear is the big marker, right? You get past fear. Now we start to get into desperation. Now it's the conversation with yourself. Should I sell? Should I not? Should I sell? Should I not? What should I do? What should I not do? Should I hold on? Should I, this is like you're on the ledge. This is now you've gone out onto the window ledge. You've opened, you've already opened the window. You've gone out there. Now you're waiting to see, wait, what am I going to do? And we'll talk about some of the steps and strategies from here that you can do. But that's the thing. This is where the biggest part and the hardest thing as an investor to do is to hang on. Hold on right now as this ride goes through. And we'll talk about that later in terms of some of the triggers and things to watch for, but some of the things that you can actually do with that. So before we get into that, let's talk about these declines, right? So including the housing market, right? The housing bubble of 2007 to 2009. If I include that, there have been 20 times that a global financial market has collapsed. And by that, I mean gone beyond 30%. The average is about 28 or so, but gone beyond 30% for a decline. And what they look like, because they all look very, very similar, is they go from the top to the bottom. And that decline, like on average, is over 50% when we have a crash. But that's max drawdown. I mean, again, usually it's somewhere in the range of about 35 or so, which is, by the way, what the pandemic was. But then we bounce back, right? We have a recovery. Sometimes we come all the way back. Sometimes we get close. And this is one of the things that Craig and I have been talking to everybody for almost a year now, is the aftershock that occurs after that decline happened, right? That aftershock usually occurs somewhere around 18 to 24 months after we've come back up. And if you say that we came back up after the pandemic by August of 2020, Greg, that was about the time that we had surfaced back up from the last drop, right? You need to voice that. You need to say yes.
I did. I said yes. Yep. Yes. Can you hear me? My microphone's not loud enough. Yeah.
I did not hear that. I apologize. Thank you very much for that.
That's just plausible deniability.
Yeah, there you go. I know in terms of that. But so August puts us, we're right at that time. We were somewhere this year, this aftershock was going to occur. It was going to happen, right? So that's where, but then what happens is we'll have a bounce back, depending on it, anywhere from like 8 to 20, 8 to 15%. And then honestly, we go squiggly for a while. It sort of bounces along trying to find the bottom, trying to see where that bottom is. We go sideways for a while. And then honestly, the bull market will run. And the bull market will run for like 5 to 7 years. You can take this, literally look at all, especially 2007 to 2009, overlay it right on top of this. It almost works exactly like that. But this is the average when you do it all out in terms of what the numbers were and what it looks like. So the idea is, where we are today is probably here in the aftershock. So what's going to happen from here? And this is the whole thing. Where are we going to go? I don't know that we're going to have much of this recovery occur, this second bounce. My belief is that we're going to go squiggly here for a while. That's a technical term, go squiggly, right? You know,
It's an industry vernacular.
yes. You know, unfortunately, right now, that aftershock has us really, really close to this bear market. You know, the bears are out. They're out in full force right now. They're barking. I don't know what bears do. Bears bark. What do bears do?
Oh, they grunt.
They growl, right?
Oh, they can growl. If you're hearing growling, you're in trouble.
Okay. Well, we're in trouble then. They should be growling. And that's what you
first. Then they hit a growl. It's all over. You don't hear much after that.
So here we are with the S&P 500, right? So the S&P 500, the 52-week high again was in 1/3/2022. It was 47.96. If we were in correction territory, that's 43.16. Today's close was 39.30.
Oh, I gotta do math now.
Yes, well, a bear market would be 38.15. So we dipped into the 38s too. It ticked a little up at the close. We were in like the 38.70s there for a little bit towards the end of the day today. So we're close. It'll see what happens tomorrow, you know, in the next couple of days and what goes on here. But, you know, we're treading right near bear territory. And the worry is that if we do fall into bear territory, that you get some of that, you know, Craig, that panic selling, that herd mentality that goes along with it.
Yeah, right. And that's what, you know, drops it down below that bear market level is that panic at the end, that emotional, I got to get out of here before the whole world ends.
And we're going to talk about that because that's one of the indicators that will come in to watch as we go forward here to see where that happens.
Before you move forward, trivia from last week's session. What's the lie on the screen here?
Oh, that was for you. It's the number of companies in the S&P 500. Technically, there are 504 companies in the S&P 500 now. So Craig, I caught him on that. So he was made a little fun with that. But as I said to him, they're not going to call it the S&P 504 because the company may drop out of it. So they're just going to call it just like the Big 12. You know, the Big 10 has 12 teams, but they're not calling it the Big 12. They're calling it the Big 10.
All lie.
If they don't want to change the name, yes. All right, crypto. Crypto. Ooh, crypto's burning at this point. Crypto is literally on, you know, absolutely tanking at this point. You know, so the 52-week high happened to be last year for Bitcoin in sometime in November of last year. You know, it closed almost 68,000 for a coin. That meant correction territory would have been at 60,000. It closed today at 28,400. It doesn't really ever close, but I looked at it before this at about 6 o'clock. It was at 28,400. It is down over 50% at this point. And
And why would that be?
That's the whole thing. Well, I can tell you one of the triggers and what happened. I was going to save it for the, you know, all about Bitcoin for in a couple of weeks, but I can do it here in terms of that. So
we have another trivia question for 2 weeks from now.
Yeah. So much like a money market, right? So a federal money market is pegged at $1, right, and is not supposed to get unpegged. It's happened, right, that a money market dollar, the value falls under $1, but then you have pandemonium and craziness because it's supposed to be at $1. Well, the same thing is there are coins that there is a Tether coin and other coins that are actually pegged to the value of $1. They just unpegged over the last 2 days. So now they are falling underneath. It's not supposed to happen, right? That's not supposed to happen. And what you now have is this, you know, almost like this going, you know, hey, now I'm going to go buy the tethered coin at 98 cents because it's got to be valued at $1 sometime later down the road. that are going to make money on it.
Well,
Not, go ahead.
I would say the issue with Bitcoin is just like, it's a virtual coin, right? Which means it's virtually there and it's virtually not there. There's nothing behind it giving it real value. Until you have some regulation, until you have real currency backing, then it can go anywhere. And it's
Well, right, but that's what the tether coins are supposed to actually, put some sort of real world value to it.
Okay.
That's the idea. So, that's what part of what's going on right now with this. I thought the interesting one, and just looking at crypto, just we're dancing in this conversation here. One of the bigger exchanges out there is called Coinbase, right? Coinbase, if Coinbase goes bankrupt,
yeah,
they get to keep all the crypto.
Oh boy.
So there's an interesting one for anybody out there who has coins on the Coinbase exchange that are not in your own personal wallet, which is basically the mantra here is get your own personal wallet, get your coins off of Coinbase. Because if Coinbase goes out of business or goes bankrupt, the coins actually revert and become their property to pay off creditors, essentially. Just an interesting little tidbit I saw the other day. I'm like, well, okay, that's a little scary, don't you think?
Makes it even more concerning.
Yes.
Even more emotional, right?
So the U.S. Treasury, right? So the yield at the beginning of the year was 1.62. We actually crossed over 3% after we did Cinco de Mayo because it hadn't gone there yet. So on 5/9, actually crossed over 3%. We're back down. We're at about 281 today is what the closeout on the 10-year Treasury was. But so it spiked, right? So some of that was going on. And Craig, if you can remember from last time, what was the last time it closed over 3%?
Oh my God, the last time, I think you said 2006, but I'm not sure.
No, you said that at the time. That was in your brain. It was 2018.
Oh. So
October
of consistent.
Yes. But this is just saying, what's happening in terms of going on with the Treasury. The yields spike. It's an inverse relationship, and we're going to talk about the inversion curve in a second. But so that price to yield is an inverse. So as the yield is going up, the Treasury values are going down. Unlike the barrel of crude oil, right? So anybody who's been to the gas pump in the last week has seen the spike in prices going on. 1 year ago, that's the current. Oh, I did it backwards. Right?
It wasn't that a year ago. I thought it was like $48.
Yeah, no, it was 60. I did it backwards. That's funny. I don't know why I did that. Anyway, currently it's at a year ago it was $66 a barrel for bent crude. But that, there you go. That's what's raising the price on this. Anytime oil goes over $100 a barrel, we're in trouble. And we're going to head towards this. What did I get gas at? Costco? Right? It was like $4.25 for Costco. It's crazy. But anyway, that's what's going on in terms of pricing out there. So you're starting to see a lot of that. And it gets us into that whole conversation about inversion, inflation, recession, oh my, what's going on out there in the world. And inversion, we bring this up specifically because of what's happened, right? So again, the yields move inversely to the prices. So that means as the yield keeps moving up, that means the value of those treasuries is going down. But the watch on this is the 2 and 10-year Treasury. And the adage and what has been historically accurate is that whenever the yield on the 2-year Treasury is paying more than the 10-year Treasury, which, Greg, for most and everything, right? If I was going to give you my money for 10 years, I'd expect to get more than if I was giving it to you for 2 years, right?
Commitment, bigger return, right?
Exactly. But every time that inversion has occurred, right, it has pretty much been on target that we are going to go and hit a recession at some point in the future, right? Since 1955, it's been every time we've had a recession, we have inverted before it. The recession only happened once where the inversion didn't occur. Since 1900, it's been right 80% of the time. So it doesn't miss very often. I think there were 28 occurrences that we had a recession. It was right 22 times out of 28 that the inversion occurred. It is not 100% foolproof. It is not absolutely infallible, but the reason we bring it up is because the curve inverted on 329. Now, and a recession doesn't happen immediately. It doesn't happen right out of the gate. Usually what happens is the party continues for a little while, right? You know, things go up, we're all, woohoo, everybody's still good. We party for like 6 or 8 months. And then somewhere in that range, around 9 to 12 months, recession kicks in. The reason we bring this up tonight and for this is because this is sort of, hey, we're dealing with all this pain right now, but there might be further pain coming down the road because of this. Not telling you that they're tied together, that this is going to happen, but it's just that indicator that, hey, this is what could occur. And so you've got to be wary that, gee, all right, maybe we get through this now. Maybe we don't close to a bear, Craig. Maybe it picks up a little bit. We start moving in the right direction and everybody's back on the roller coaster and heading back up that way and going, woohoo, okay, you know, just like happened in 2020, like all of a sudden everybody's still plowing money in and having a blast with it. This could occur. So just be aware of that. Just know that's something down the road to be thinking about. And then inflation, right? God bless. Well, you know, this is something that's coming. So I told you, right? They just released the report yesterday, the CPI for April. The target that the federal government had, the federal Reserve, was 8.1. We were 8.5 in March, if you remember. Came in at 8.3.
Split the difference.
Yeah, split the difference, but it's like it's funny that depending on who you're reading and looking at, like it's almost like a sigh of relief, like, oh, it didn't go up anymore. I'm like, it's still 8.3. Like, what are you talking about, right? Like, whoa, we didn't go past 8.5, so maybe we're going in the right direction now. That type of thing. I'm like, okay, that's a little different take on this than I think I would have for that. You know, it's still trying to get inflation in check. And that's the job of the Federal Reserve Bank. And, you know, the whole idea here is the Federal Reserve Bank with the interest rate raise and what they're trying to do is they're trying to bring this thing in, rein it under control, and do what they call a soft landing, which is to bring this plane in safely, which is what Craig is responsible for with our show this evening. Unfortunately, unlike Craig as our pilot, the Federal Reserve Bank, I don't believe, has the ability to do that with all these other factors that they're trying to juggle at the same time. Which is
to do like us and drink while they fly.
Yeah, see, there you go. But you have, you know, the supply chain issues and labor shortages and all these other things that are pulling and tearing at the same piece of cloth that the Fed is trying to sort of navigate through with all of this. So it's not an easy thing. And it's going to be interesting, and it is one of the indicators to watch to see where this is headed with what they do. We'll talk about that in a little bit. All right, so recession, right? As I said, the only reason we bring it into the conversation is because of that inverse curve. You know, the economy had been churning along, like we talked about, you know, it was all, you know, rainbows and unicorns for a long period of time there where nobody was looking or worrying about anything. Now, suddenly, like in a blink and in a twist, from February to March, all of a sudden it's, wait a minute, we could be going into recession. You know, it's that much of a 180 spin in terms of the economy and what's happening right now. So it'll be interesting to see how this sort of gets guided through that, but it is one of those indicators to watch, you know, where the GDP is going, where inflation is moving, and how that's all connecting to each other. You were going to say something?
Yeah, I'm just waiting for you to thoroughly depress everybody enough so I can make them feel better again.
Why, you got a blender? Is that what it is?
Well, I have a blender, yes.
I told you this is, you know, but wait, okay. So now we're going to get to some of the better parts. Okay, so we'll try to do that, and maybe you should take the running with the bulls thing, right? So, you know, where do we go from here? Well, two very distinct views on everything from here, right? You got the bulls and you have the bears. The bulls, this is an up market, right? Still an up market, still a good economy, still everything is there, and that this, like Craig and I just talked about. that whole idea of panic and fear is a buying opportunity. People are selling for more that their fear is what they're selling out of than economic reason or an understanding of that. So it's an opportunity to be buying in. From a bull side, that's absolutely the case, right?
Yeah, absolutely. Yeah, I mean, a big issue with a lot of people who invest, and it's not the algorithms that do it, even though they do push the markets up and down. It's when people see these algorithms happen and the markets go up and down, they make an emotional decision to either buy when the market's running up, which means you're buying when everything's more expensive, or sell when everything's going down, which means you're taking a loss. So it's really counterintuitive to how you do everything else in your life.
Yes, absolutely. That's always been the case. But from a bull standpoint, again, Craig wanting to be a little bit more positive here because he doesn't have his blender, right? Is that the pain, you're pretty much through the bulk of it. Again, I'm taking this from the bull side of the fence or side of the market or whatever you want, that they don't see it going much further down and that the rebound will start happening from here. So that's if you're listening to, growth economists, bulls, that type of thing. That's what you're going to. So, you got to filter some of this stuff sometimes.
So
The
we
bears
don't have that double whammy from the inversion.
So, but that's not well, you've got to move over onto the bear side of the world to do that, Craig. So the bulls are all growth and everything's an up market, and we're headed in that direction. With the bears, yeah, there's more pain to come, right? And more pain that might be very, very quick for us here. And we'll talk about that with one of the indicators in a second. The reason that they're saying it is that the market is still widely and vastly overpriced, and inflation is nowhere near under control, and the Fed doesn't really have a game plan for that, right? That was another one I saw. There's another, just like Bitcoin, because it's sort of like the pandemic thing that sort of pumped up. That is Robinhood. I don't know if you saw that. Robinhood, the value of Robinhood, the trading platform, down over 73% now.
So I've talked to a lot of people who jumped into Robinhood and are asking me, should I have done that? I think
and now most of them have jumped out or they're not trading anymore.
Right.
They're not seeing that, hey, everything's not going straight up. What's happening, right? So, it's one of those things with it. From the bear side, they'd be like, hey, look, I told you that was going to happen. So, because this is the way it goes, and you got to have sort of a game plan and understanding. But again, depending on who you listen to, depending on what you're watching or reading, you got to have a little bit of an understanding of the slant that they're taking on it. Because everybody's got a vision one way or the other. They're either a bull or a bear, and it clouds how they present what's happening in the world. So you just got to be aware of that whenever you're reading or looking at anything. All right, those three key indicators, right, that I talked about. So what we want to watch going forward, specifically right now. And Greg, you mentioned one of them, though you didn't really know that you were mentioning one of them, which is what's happening to all that fear, right? So the volatility index, otherwise known as the fear index, right? That's a number that you want to look at. It's the VIX, that's what it's traded as. That number, when it gets past 36, is usually a good indicator that, investor fear has gone way, way up. And people are selling for reasons other than economy and price to earnings ratio. They're selling out of fear at that point.
Jumping off a cliff, I might as well jump too, right?
There you go. That herd mentality, exactly. So right now the VIX is at about 34.5. So we're close. It's a spike. It's spiked up, but of course it spiked up because what's gone on in the last 10 days, right? So we understand a little bit of that. But like I said, the thing to watch is as that number starts to tick north of 36, understand that most of the selling that's occurring is purely out of fear. And so that's from the bull side of the standpoint. And for value investors, that's an opportunity to look. And we'll talk about some of those value investing opportunities possibly to be looking at a little later. But that's a number. That's an indicator you want to watch, especially now, because I think short term that number is going to spike and you might see some of that tumbling into bear territory because of it. Like it wouldn't surprise me if we wound up the end of this month like down 25 or even 30% possibly. We could go that far type of thing.
I agree. If you can't hear me.
Yeah, I could hear you that time. Inflation.
You take a drink before you say inflation? After
Yeah,
you say
that's it. We did talk about that last time. Now let's keep that in check. We were going to do on Cinco de Mayo. We were going to make it a drinking game. We decided
Oh.
not to. That it would ethically and morally not be. So we're not doing that. But inflation, right? So again, watching the inflation numbers. If the inflation numbers continue to go or stay around where they're at, then the Fed isn't doing their job. And whatever they were trying to do is not working. And what that's going to do is lead us even farther down a path to more or quickening. And we'll talk about the Fed in a second, because that's the third part in this. It's a tightening of all of this spending and what they're doing. So watching where inflation goes is definitely an indicator for what's going to happen here in the short term, because the Fed is not going to meet again until June. So you got a month or so. Go ahead.
Well, I was going to say that, I've been talking to lots of individuals in the last couple of months, especially since the inflation rise has been going up. And I think part of this inflation number, one, was, we have had almost no inflation for 10 years, right? Second, we've been knowing the crash is going to come, because the higher things go, the farther they fall. So some of this is expected. But on the other side of it, I think, I'm seeing a lot of people actually getting raises. I think you're seeing salaries going up, at least in a segment of the population. And so the issue is it real raises? Is it real cost of living increases? Or are we just keeping up with the pace of inflation? So, I don't know. And I think really a driver for that has been COVID. People don't want to work for what they were working for before. Right. It's very difficult. Unemployment's at an all-time low. If you're going to look at moving positions, this is a great time to negotiate, or at least look.
Right. So well, some of that is actually how they view those numbers. Let's remember that some of those numbers, once you're not on the roll after 2 years, you don't count anymore. So you're taken off the roll, and you've got people who've been out for 2 years. They don't count against the unemployment number anymore.
All I know is I've seen a lot of my clients getting thrown silly numbers for raises or new job offers that they never were getting before. So I think
and that's great. It's a good thing, right? Yeah, no, but I think that, and like you talked about, that inflation is a part of that. It's a driver to that whole thing in terms of going through it. And then the same thing, it absolutely to watch what the Fed is going to do. The Fed raised the interest rate 50 basis points last month, this month.
So you're like in the middle.
Jeez. They won't meet again until June 14th. That's the next Fed meeting. The question is, what happens between now and then? And does the Fed have to get crazy and do something, another 50 basis point raise of the interest rate, and the market is going to seriously tumble, because it's not built for it. It's not built for the Fed to do that. It can take the 25 every month, right? And it works out the same way, but you hit them with 50 and it's just like, wait, I can't take that. So something to watch what the Fed is going to do. And again, the previous, inflation number is going to be a marker on them. If this thing is not in check or under control in the next, couple of weeks, they're going to have to seriously look at doing another possibly 0.5 point rate increase. And then who knows?
Yeah, so a rate increase with slow inflation?
Yeah, because you make things more expensive, it causes it to come down. Yeah. Right. Because remember, part of this is by putting that rate increase on it, you're trying to bring the cost of goods down. Right.
So financing it is more expensive, than the cost has to be cheaper. Right.
Correct.
Like your home prices.
Exactly. Yeah. All of that stuff, everything comes in on that. And so that's part of the process in terms of trying to rein it all in. And there's only so many things they can do, right? It was just like the other way around when they're trying to stimulate, once you get to zero, there's only so much you can do past zero, right? I'm at zero. What do I do now? So they're going to keep trying to bring this in, but they can't get too crazy, because if they get, like we talked about last week, if they get too crazy, then suddenly everything stalls. and you get this whole stagflation thing going on, and cost of goods skyrocket in that scenario. So you got to be, that's the whole point. That's the whole soft landing thing, Greg. I want to come in a soft landing. I don't want to have any of this craziness go on around me with it. All right, so this is we've been doing this now for a couple of years. This was our mantra for COVID, which, everybody said, wash your hands and please don't touch your face. So, for Craig and I, we used to say, wash your hands, please don't touch your 401k, just leave it alone, right? And we still are going to say that as far as your 401k is concerned, your employer retirement plan, I don't care what it is, 401k, 403b, simple, SEP, whatever. Leave it alone. That you shouldn't make any changes to unless you're going to retire next week or next year type of thing, because that you should have already done anyway, right, Craig? You're a little late to that bus as far as doing it.
Yeah, I mean, if you're on a glide path, you should be, actively working the glide path and not being reactionary to the marketplace. Because if you're doing that, then you're already behind the 8 ball.
Right. But your outside investments, right? Now you're not in your employer, not a tax deferred IRA, 401k type of thing. Those you might want to take a look at. Those maybe we're a little late to the party right now because of where we're at. Like I said, almost down 20%. But we'll talk about, what that means really, and to review what your strategy is. For a lot of us, we started out with a set portfolio mix, whether it was, 80-20 as a growth investor, that's 80% equities to 20% bonds and cash, or a moderate middle of the road 50-50 blend, 50% in equities, those are stocks, 50% in bonds and cash. But nowadays, who knows what your portfolio looks like? Between the crash, between bonds having not done anything, who knows what that mix is like? And in some cases, for some people, Craig, like we run into this all the time, where they haven't had bonds in their portfolio for 4, 5, 6 years because the market was running up so much, they just haven't done it. And now they're taking it on the chin.
Well, I worked with a client recently, and his 401k portfolio was actually 99% stocks. Crazy aggressive. But I think with the long run up, he even said, I just kept riding.
Well, that's the whole idea, to take a look at that allocation strategy. The other thing you can do is what's known as a crash test. Now, we're in the middle of a crash, so you're sort of getting that right on in terms of looking at it. But you can also sort of project, tell me what, if the GDP declines, tell me if oil continues to rise or gold starts to tank. There are different scenarios that can be built in that you can look at and say, how am I going to weather this as we go forward with some of these indicators that we've talked about? So to crash test your portfolio is always a good idea. Remember your time horizon, right? A loss is only a loss when you sell, Craig, right?
You lock it in for sure.
That's it. Otherwise it's on paper. So, it depending on your time horizon, and that's why we say for most people, as far as retirement plan investors are concerned, just stay the course. Reassess your appetite for risk. If this is not telling you the gut punch, if this is not saying to you, I can't take this anymore because now we're in a second almost bear market and, basically 2 years now, it's just over that in terms of going through it, then maybe you need to be looking at what your allocation strategy is. So it's a good time to reassess what your appetite for risk is, because for Craig and I, it's always about risk. It's what you're willing to risk. It's not about the return. It's how much risk are you willing to take to get that return, and are you doing it in an efficient way?
Absolutely. Right. Yeah. If you can't put your head down at night, then maybe you're overly aggressive.
Yes. Right. Or if it's really starting to make you angst and, getting crazy on it and checking your portfolio every 20 minutes to see what's going on, yeah, then maybe it's a little crazy. All right. So now we come, Craig, this is more of the positive for you, right? So, what can you do? Well, right now, everything is on sale. So the adage that we always use is, I don't care what your favorite store is, but just imagine if they told you that everything in that store was now 20% off, everything in the store, no matter what. Do you think maybe you'd go and take a look and say, well, maybe I was thinking about buying this thing or had my eye on that. Maybe I'll go take a look and buy it.
Polls cash with me, so might as well, right?
Whatever it is, right? Whatever your favorite store is. Well, that's the situation right now that's going on in the market. I mean, everything is on sale. And so the idea is maybe this is the time to be looking at it. 2 years ago, 1/2/2020, the S&P 500 was at 3234. Again, we closed at 3930. But when I look at Amazon, Amazon was at 1874 2 years ago. It's now at 2112. It's down, but it's still up from where it was.
Big surprise. Thank you, COVID, right?
Yes.
I think Amazon created it.
Could be, it could have been a business model. Now, another one, this is just what we're talking about, like looking at some of those values, opportunities, depending on your appetite for risk and what you're doing. One of the ones I like to look at is Disney. So on 11/15/2019, Disney traded at $144.67. So the reason that 11/15/2019 is important is because Disney over that weekend launched Disney Plus, their streaming service. What is that thing with Baby Yoda? The Mandalorian? What was that? Is that what that was? Yeah, okay. The Mandalorian, right. So Disney Plus. Now, today, it closed at 103. So if you were to buy Disney today, you're literally buying Disney pre the streaming, the Disney Plus add-on, and getting it at the value way under what it was when that service went into effect. So it's things like that you can actually look and see what's out there in terms of the market, depending on your appetite for risk. Will it continue to drop? Possibly. Will people no longer want to watch Baby Yoda? I have no idea. I can't tell you that. But those are some of the things that you can be looking at as far as opportunities, because like I said, everything is on sale right now. All right, so one of the other things you can do in this, because we're dealing with the house logger, right, Craig, is going through.
We're coming up on about 49 minutes, just so you know.
Okay, I'm going to be real quick. I was trying to get out of here. See, thank you, Craig. I appreciate that. So what's in your buckets, right? So real quick, one of the things that you can do as far as this is put together a saving strategy so that when downturns do occur, you're not getting yourself into trouble. You're not running into that problem. First bucket, short term, that's emergency reserve. That should be filled with, Craig, they usually say, what, 3 to 6 months as far as expenses?
And, yep.
If you can do it, great. But that should be the goal to be saving towards. The second bucket is for midterm spending, and the third bucket is long-term, which for most people is usually retirement or, funding the education need of a young child. So you want to make sure that you've got those buckets set up, that you are saving so that when a downturn like this does occur, you're not in a tight situation, that you don't have to turn and start tapping into some of those funds, whether they're retirement funds or whether they're non-retirement funds that are down, because you're never going to recoup it, right? Because that's the adage, Craig, right? When the market goes down and we have to use those funds, the recovery is almost never going to take place.
You're double dipping. I mean, yeah. You're down, and then at the same time, you're pulling money out while you're down. So if you don't have as much money in there, it's hard for that to come back. So
absolutely. So one of the things that we do here at Aries, we try to help everybody have a clear vision of the road ahead, an understanding of where you're trying to get to, what you're trying to accomplish, where you want to be. We do that with what we call our roadmap to financial awesomeness. This is a visual overview in terms of where you're at and what you're doing. Craig, if you want to, if you can drop the link in the chat box. If you're interested, you can type yes into the chat box. You can reach out to us. We're happy to do that with you.
Yep.
Thank you. So keeping the what's on, the think with a drink theme going, it's what's on tap. Next week, we're going to do buying a home. We're going to be drinking Sunny Ridge from Jack's Abbey. On the 26th, it's going to be all about able accounts. These are accounts for, if you know anyone or have connection to anyone who is differently abled or has a disability, an able account is a valuable tool. The problem is they're very new. They've only been in really the full marketplace here in the country for only a couple of years now, since like 2017, 2018. So still a lot of misinformation, unknown information out there. So we're going to do a piece on that. On 6.3, going back to what I was just talking about, it's all about Bitcoin. I didn't have that on there. For all about Able, Craig, it's going to be Pearly. And then I don't know what we're drinking on the I'll figure that out for Bitcoin. We might need the blender again for that one.
Okay.
Craig and I in our more formal attire. So that's our contact information. You can just reach out to us at any time. Again, if you ever have any questions, go to the website, www.ariesfoundation.org, or you can reach us by email at info@ariesfoundation.org.